Now that you finally decided to invest, the next big question is, should you hold on to your investment, or should you just flip it for quick profits? In this video, Ben will decide which one is the better choice. In order to come to a solid conclusion, we will compare factors like profitability, required planning or expertise, time consumption, and emotional impact. When it comes to trading and hodling, the main difference is selling activity. Meaning, traders spend over 10 times more hours engaging with their investments. Their goal is to buy low and sell high. They may continuously do this as frequent as every hour, even minutes. Others may do it on larger time frames, like weeks or months. Meanwhile, a hodler would wait at least a year or decade before they sell a position. Speaking of decades, if you hold your investment in the traditional market for 10 years, your average return would be about 8%, and a near 10% if you hold for 15 years. For speculative markets, these figures triple or more. In the last decade, the average return for just 1 year in silver was 31%, 15% for gold, and 911% for Bitcoin. On the other hand, traders deal with more dramatic numbers. For example, 95% of traders lose money. However, there is a small 2% of them who benefit quite nicely. Successful stocks traders can earn up from 10 to 60% a month. Leverage trading can be even more lucrative, but the risk is monumental. Being part of the successful 2% of traders comes at a cost. You need years of experience for seasoned intuition, a strong understanding of technical and market cycle analysis, and a non-biased approach towards risk-to-rewards ratio evaluation. Investing long-term is the complete opposite. A basic understanding of cellular usage is really all you need. Platforms like Robinhood and Coinbase make it very easy for anyone. Now let's go back to trading. Because trading is in theory like gambling, it can be emotionally taxing. This extreme level of stress is even worse when trading with leverage, in which there is a chance you could lose all your money instantly. Basically, 1 minute you may feel like Bill Gates, the next one you're begging. Highly experienced traders are better at controlling their emotions. But for about anyone, if a trade goes south, panic and serious anxiety start to settle in. Hodlers do not deal with much anxiety or panic. Their time is likely spent researching future investments or casually checking their portfolio. Another disadvantage to trading is that you might find yourself enslaved to your trades. Traders have no choice but to glue themselves to their trading device until they finally close their entry. Due to this intense level of activity, trading requires concrete strategy and discipline. It is crucial to have targets, goals, or objectives in place before executing a trade. More specifically, as a trader, you should plan on when to exit a trade or enter another. Since most hodlers wait at least a year to exit a position, there isn't much strategy or planning needed. Hodlers simply accumulate their holdings over time. After all, practically speaking, patience is needed for either one. What we learn is that trading can reward you bigger returns, but that comes with more risk and emotional discomfort. The question is, are these things worth being compromised for quicker or bigger returns? Financial planners commonly suggest long-term investments over trading, because it can be as rewarding while being less risky. So Ben chooses the hodling route. The good news is, you may not have to choose one over the other, because more often, professional investors utilize both. They would trade and use the profit to increase the size of their long-term investments.